And our guest tonight is Dariusz, Chief Investment Strategist with CFC Seymour in Hong Kong. Dariusz, thanks so much indeed for your time. Now, what do you make of these comments from Ben Bernanke?
It seems clear that the Fed's chairman is pretty much resigned to the fact that the U.S. growth is going to slow very substantially, although he doesn't believe in a recession yet. And he suggested that inflation will not be their focus right now, but rather they will cut rates significantly in order to avert the risk of even deeper slowdown.
Yeah, cutting rates, of course, some people are saying maybe 75 basis points is something that what the Fed is looking at this point in time. Do you think that the Fed is likely to cut rates before the end of the month, before it meets for its policy meeting?
I don't think so, because it's less than 2 weeks left to the next meeting. So it doesn't appear that the timing difference between, let's say, tonight and at the regular meeting would be meaningful. And I also do not believe that they will move by 75 basis points. This would simply be too dramatic. I think that it will be 50 basis points now and then 50 basis points at the March meeting. So still substantial easing, but not as dramatic as some people are speculating.
Well, the U.S. economy, of course, is headed for some pretty tough times ahead, but strangely enough, some analysts are viewing this as being positive for Asian markets. Do you subscribe to this flight to quality theory?
Not really, actually. I think that it has been made very clear this week that Asian markets have not decoupled from global or U.S. markets. We have declined so much in Asia so far this week, purely because of correlation with what happened in the U.S. Now, as far as economic growth is concerned, I don't think Asia will slow much as a result of a recession in the U.S. So some decoupling on the macroeconomic front does exist, I believe, but unfortunately not on the market front, and that's why indices in Asia fell by up to 8% this week.
With the markets so volatile now, though, in the short term, what do you think your advice to investors would be? Should they perhaps raise their exposure to other asset classes like bonds or cash or commodities?
I believe it would be wise to have an above-average component of cash in your portfolio precisely because of the very high volatility. Bonds seem to be too expensive to me right now, especially treasuries. I think all of the bad news is pretty much priced in the very low yields there. Commodities are also very risky because they are exposed to global growth as much as equities are. However, the agricultural commodities, I think, will still see good times due to very high demand. Equities, on the other hand, have been oversold to the degree that a lot of them are looking really attractive, especially if you are able to invest for, let's say, a year and are not afraid of margin calls.
Okay, Dariusz, good to talk to you. Thanks so much indeed for your time today. Dariusz from CFC Seymour in Hong Kong.